Canada's controversial capital gains change is now in effect. That is despite pushback from not just investors and small business owners, but also farmers and doctors. What does it mean? Well, individuals with capital gains of more than $250,000 will have to pay more tax. They'll be subject to an inclusion rate of 67%, up from 50% before. The change prompted a flurry of last-minute planning by many Canadians, and for a debrief on the changes, we're joined by Jamie Golombek. He's Managing Director of Tax and Estate Planning at CIBC Private Wealth Management. Jamie, good to see you.
You too.
How busy were you last week?
It was absolutely crazy until Friday, because that was the last trading day to get all your trades done to settle yesterday, which was Monday. So lots of discussions about what should I do with my portfolio, what do I do about my vacation property, what do I do with my private company. That has all died down completely. We are now in the new regime of the 2/3 inclusion rate.
Okay, so in this new regime, for those who weren't doing any last-minute action, what do we have to know about the changes?
Well, again, for the average Canadian, this will not make any impact whatsoever. You have to have over $250,000 of annual capital gains for this to actually impact you. So again, a capital gain is the difference between the selling price of something and the cost. So typically a stock price, the proceeds less the cost base is your capital gain. You add up all your capital gains. If they're under $250,000, 50% of that is included in your income. Anything over $250,000 will, as of today, be taxed at a 2/3 inclusion rate.
And for people who were making those last-minute decisions, some might be around a stock. Maybe it was a shorter-term decision. It felt like, though, for a lot of Canadians who had amassed wealth in different assets, we talk about properties or cottages, this was in retrospect, a decision many, 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 many years in the making, but one that they had to very quickly make because of the changes.
Well, that's absolutely right. And I think many people decided to do nothing because it's a wait-and-see approach, because, again, this rate may not be here forever. It may go down in a future government. But ultimately, the problem with triggering a gain is actually have to pay the tax. And a lot of people didn't want to pay the tax, especially if they weren't selling the asset. So, for example, there were transactions that one could do to crystallize a gain on a piece of real estate or on a vacation property. But the problem is you still own it, and therefore you have to pay the tax next April 30th. People didn't want to do that. So the most activity that we saw primarily was on the stocks. People had shares like NVIDIA, shares like Apple. They had enormous gains on those shares, and there was an opportunity to take some profits there and take those capital gains at the lower 50% rate.
So when you're trying to make a decision like that and then think about sort of the broader wealth planning and tax considerations, how did that factor into some of the conversations you were walking clients through? Because that is one decision, but it's all kind of part of a broader decision-making that an individual would make.
Absolutely. And we always say that tax should not be the primary driving force behind any decision. So you really want to look at the big picture, look at your investment portfolio. What are your rates of return? What is your time horizon? What is your risk tolerance? And ultimately, what percentage allocation do you want to certain stocks, certain industries, et cetera? So do you have overexposure? Do you have high concentration? Those were the opportunities that some clients took in terms of profit taking, because they figure if I'm going to sell it anyway by the end of the year, the next couple of years, maybe I'll take those gains before June 25th and pay tax at a lower rate. But absolutely, it's part of the broader picture of asset allocation.
So what happens now, whether it's a stock, whether it is a small business owner, for example, in terms of the timing on how they should think about it? Like the tax change takes effect, you mentioned, and politics is politics. You never know. Things might change in the future, so maybe that's a reason to hurry up and wait. But do you think that people who are making these kind of decisions are going to have to take a longer-term approach if they want to be sort of mindful of the tax bill that they're facing now, or?
Well, it's either a longer or a shorter term approach, depending on who you talk to, because now that you have this $250,000 gain at the lower rate, some investors are saying, well, as soon as my property hits $250,000 of gain, I'm going to sell it and then invest in something else because I can get a gain at a lower rate. So there are a couple of different approaches on that. Other people may take a long-term view. Look, I have no intention of selling this anytime in the near future. I'm going to hold on because maybe in the future, another government will come in and they will perhaps reduce that particular rate.
Okay, and would you say, so stocks, vacation homes, income properties, just walk us through the various assets that are ultimately impacted by something like this.
Yeah, so again, in terms of stocks, you probably have to have a pretty large non-registered portfolio. So we're not talking about your RSP, we're not talking about your tax-free savings account or any kind of registered plan. We're talking about a non-registered portfolio. And again, to have more than $250,000 a year of gains is huge. That being said, there could happen on death. So on death, there's a disposition of all your property at fair market value. So again, that could be a big impact. And therefore, people that are older who want to do some estate planning might think about triggering some of those gains each year to keep themselves under the 250. When it comes to a vacation property, there are simple things that people can do. If the vacation property is bought jointly between two spouses or partners, each of you gets $250,000 of gains at the lower rate. That might be an opportunity there in terms of purchasing that vacation property, and then ultimately keeping track of things like capital improvements. So many people buy a property and then they improve it, and that is added to the cost base. And therefore, when you sell, your gain could be lower. So these are the kind of things that you want to keep in mind going forward, given that we now have a higher tax rate on a capital gain.
Reassessing what the actual capital gain is, the way that you assess, what your actual income is versus the costs and all that kind of stuff. And then you talked about that that splitting, if you will, I guess, sort of if it's between a couple or two people, that you can essentially factor that into your thinking around capital.
Absolutely. So if the property is jointly owned, so in other words, each of you, let's say two spouses or partners buy that property together, then upon sale, that gain would be split 50-50, which means that each person would have the $250,000 at a preferred rate of the gain.
Do you think you're going to see more planning of this nature because of the change in the inclusion rate, which at the end of the day just increases the amount of the tax bill that you could potentially be facing?
Yeah, so we're already seeing some planning. I mean, certainly discussions around life insurance. So for example, some of our clients are using permanent life insurance to ensure the tax liability on a vacation property. They're worried that when they die, they don't want their kids to have to sell it to pay the tax owing. I mean, you could inherit a cottage for $300,000 30 years ago. It's worth $1.3 million. You have $1 million gain and you die, you want to leave it to the kids, and there's no cash. So some clients are using life insurance to pay for that, to provide liquidity. They now need about 9% more insurance simply because the tax rate has gone up by about 9%.